I want to welcome on today's guest, Mish Schneider. Mish has been a frequent guest on the Final Bar. She is the Director of Trading Education at Market Gauge, coming to us from Santa Fe, New Mexico. Mish, great to see you. Happy New Year.
Happy New Year to you.
So we're in this sort of interesting, choppy, kind of sideways, uncertain period. You're showing us your chart of the KRE, the Regional Banking ETF. Can you talk us through what you're seeing in the space and just how you're making sense of the markets here?
Well, I chose to bring this chart to Final Bar today because it's a sector that people don't really think about very much. It's part of the economic modern family. It's my prodigal son because, as we know, banks have had a history of getting you all in and then totally blowing your money, and then, of course, coming back asking for forgiveness and getting bailouts. And as we're going into bank earnings, I thought this was a particularly interesting sector to look at, not just from a technical standpoint, but it also really takes a pulse of more rural America. What are they doing in terms of their savings and borrowing? And right now, you can see this has been floundering as we're looking at this chart right here. Above the 200-week moving average, it got real close to breaking it a few weeks ago and has held. And so what it's telling us right now is, yes, we're bouncing off some support. If you go back to look just a few months before, is it possible that we're establishing triple, quadruple bottoms? Absolutely. And that's the conundrum of the market right here. Are we simply holding support for something much worse to come, or are we holding support because we're going to get this monster rally in spite of all of the logical reasons why we shouldn't? And so you have to look here, especially this week. If we can get through 60 on the daily chart, I think that would be very constructive. If we break down under 57, not so much. You can see on the leadership bar underneath that, as long as the blue is over the red, it means it's slightly outperforming the S&P 500. And the real motion indicator below that, which is the momentum, shows that the 50 is over the 200. That's bullish. But if you look at the actual dotted line, it's hitting right into resistance. So when you talk about this sideways action and how we have these key levels to clear, this is another representative, although not nearly as strong as the others, which means it could be a ball and chain or it could play catch.
I want to get to your charts of your second set of charts here, but just quickly, if we could, we have a lot of bank earnings coming out. Earnings season obviously getting started here this week, but Friday you have things like Citigroup, Bank of America, JPM, all reporting earnings. As a technically oriented strategist and trader, how do you think about a chart like this going into earnings? Is there some way that you would look at it differently, or do you just focus on the price action as a way of navigating what could be an uncertain period here?
Well, I certainly will look at the price action, but I also look at the different time frames because the daily charts are showing this enthusiasm that we're seeing in the overall market. And the weekly chart, as you're showing now, is not necessarily as enthusiastic, but definitely not pessimistic. So to me, the bank earnings will be interesting, but I'll be much more interested in what they say in terms of forward guidance versus what they report in terms of last quarter. And I think that's pretty much what everybody's going to be looking at. And you have a bank like JP Morgan, which that chart looks totally different. It's in a clear bullish phase and doing very, very well.
Yeah, nice run off of the lows for JPM. Next chart is your daily chart of HYG. That's a high yield ETF. Can you talk us through this one?
Well, I love looking at junk bonds because it really is such a great indication of risk on, risk off appetite. And it has been a guide for us since before COVID. So here we are now in this year when things started to look so negative even at the end of December. This chart really held up. And not only has held up, you're looking at the daily chart right here. You can see that with today's action, we almost have two shooting stars, if you're a candlesticks fan, right at a critical resistance level of the 200-day moving average. That gets pretty exciting, really, because it's going to tell you very quickly. Either this will roll over and all this enthusiasm will begin to wane, or if we can pop through this, it means that these bond traders are still looking at this high yield and not terribly worried about any kind of crash. And so that's why I think junk bonds are so key to what happens here in the picture right now.
Yeah, you mentioned the 200-day moving average. Mid-December, the HYG got right up to the 200-day and had a pretty decent drawdown from those levels. Your weekly chart of the HYG, does that shed any light in sort of the overall picture with high yield debt?
Well, it's exactly almost a mirror of what we just said about regional banks. And on
Yeah.
the daily, you look and you go, oh my God, this market looks like it's just going to explode to the upside. You step back more into more of an intermediate term, and it just looks like we're seeing a nice bounce in a bear market. And clearly that's what you're seeing here with a negative slope in the 50-week moving average, the 200-week moving average above that. You see momentum there, really not necessarily as pretty because the 50 is under the 200, which means it's still in a negative phase. And in terms of the leadership, it's on par with the SPY, but not really taking any key leadership here. So that's why I think this is still a trading range market. And these two charts essentially are telling you, have fun, have your risk parameters in. Obviously, I listened to your conversation about stop loss is so important, but also be really, really prepared that for the big surprise to the upside, or that things aren't as good as they seem right now, and we're just a few days away from some sort of rollover.
Mish, it's awesome to get your take as always. Super excited to have you involved with our market outlook coming up later this week. Give our best to the team at Market Gauge, Keith and Jeff and everyone, and we'll talk to you again soon.
Thank you so much, Dave.
That's Mish Schneider. Mish is the Director of Trading Education at Market Gauge, coming to us from Santa Fe, New Mexico. I love those charts, and a lot of little nuggets to unpack there, but I think what was really interesting, you caught a couple times, just the fact that I ask all my guests to give me, a set of charts, whatever they'd want to talk about, and we sort of start there. Mish intentionally picked two different time frames on each of the two sets of charts she gave us, and reinforced in her comments there the importance of looking at the different time frames and thinking about the weekly trend, the longer term picture, thinking about the daily trend and the shorter term fluctuations. Multiple time frames really help to illuminate. If you find that you're struggling to figure out what is going on with a particular chart, always dial it up or down a time frame and see if you can get a little more granularity, a little more color by looking at the big picture. So great take there as always from Mish Schneider from Market Gauge.